Hello, everyone. Welcome back to the show and welcome to the AthenaX podcast. I'm your host, Neil, and today we've got a very special guest here. We've got Felix Liew from Symbiotic calling in all the way from Lisbon, Portugal. How are you doing, Felix?
Very good, Neil. Thanks for having me. Yeah, very nice. Starting the summer season here in Lisbon. So excited to
Nice.
chat today to you.
Nice. Yeah, so we've been seeing some new developments in the RWA space, particularly from Symbiotic. I think you just got on the news recently as well on CoinDesk. So with Liquid Lane, which we'll of course get a little bit into later. But yeah, so really excited for today's episode. But before we get into all that, Felix, let's talk about you. What were you doing, before crypto, and what made you jump right in?
Yeah. It's been quite some time now. I joined the industry officially in 2018. So I'm coming in on 8 years, almost a decade in this industry. I actually was my first real job, aside from internships and a few things that I did before while I was studying finance in Frankfurt in
Nice.
Germany. And then I sort of came across crypto and the very early innings of decentralized, I would say. So Augur and, these protocols that came out then, and just chains and proof of stake in general, which was very interested in, since it sort of combined some of the things that I didn't know much about at that time, like distributed systems and, economic principles and how to incentivize a network and how to build these network effects through token incentives, which I found very interesting. And so I went into that and became part of a staking provider, one of the first that existed, that got acquired by Bitwise recently, Chorus One. So been working there for quite some time, and then joined Symbiotic around the start of the project as the first hire on the business side, leading partnerships and ecosystem. And, happy to dive into what we've been building over the last 2.5 years, and especially last year or so.
Super cool. Yeah, you're employee 001 at this point with Symbiotic. So you've been with them since the very beginning. So talk to me about Symbiotic here. What did you guys do that essentially put you guys on the map, and what's shaping your direction today?
Yeah, I think, we are what we call collateral market platform. So what we're trying to do is to enable this liquidity that's on chain to access different yield sources, to provide collateral for underwriting use cases or different sort of use case that might require economic security or capital to underwrite it. And, we started out with that vision in some sense with the restaking space, where we already had sort of this vault-based design. Since we're quite a DeFi native team, we saw how, applications in DeFi need to be built with this customizability and modularity in mind. And over the last 2.5 years, we've been kind of exploring what are the use cases for these primitives of shared security, let's say, but more collateral in crypto. And we came across, for one, underwriting use cases such as credit underwriting, as well as insurance underwriting, as kind of the prime use cases for where the collateral such as Bitcoin and ETH and also stablecoins are relevant. And then we essentially built systems to automate these kind of protocols on top of us. We've been working with a few partners that have built their protocols around ours, such as CAP, the stablecoin protocol, or Nexus Mutual insurance protocol. And now we've also been building Liquid Lane, which is a RWA liquidity focused protocol. So it takes on a bit of a different take in terms of how collateral can be used as well for liquidity purposes, and sort of alleviating some of the problems that we are seeing in the RWA space, and why we believe they aren't as adopted on chain yet as they could be. And we're trying to bridge that gap using sort of the on chain system and expertise that we've built over these years.
Yeah, so I remember reading once the RWA space is the fastest growing, if not, fastest growing sector in DeFi at the moment, second to stablecoins. We've seen a lot of tokenized funds, tokenized treasuries become RWAs, less about real estate. I think one of the reasons there is because it's kind of opaque. And for you guys, to come into the RWA space from underwriting insurance, it's kind of like a big difference in what you guys were doing on your day to day and how you kind of view these different products here. So I just want to know and touch on a little bit about the RWA space for a bit. Why do you think we're seeing so much innovation here, and where do you think we are in progression of turning the RWA sector into something a little bit more mature to the same level as DeFi?
Yeah, This is a great question. I think we're currently seeing a lot of interest in it because I think there's like a few like tailwinds that push it. One is just these institutions that have been looking at crypto rails for the last years are kind of maturing in their kind of adoption curve and like assessment and of the product and where they can fit it into their systems, especially driven also by stable coins and just the payments use case as well. And so everyone's trying to build like something around it like for real and bring it on chain nowadays. That's also like part of the other reason, which is like the infrastructure has matured over the years. Like just the chain, the gas fees are like kind of down. The system can handle like significant load. It has proven itself in terms of like lindiness, in terms of like the lending market and sort of these core financial primitives that are there. So like people are comfortable using them also for other assets. And then like the one that really makes it interesting right now is just that in like crypto native, like the circular economy that's just like based on crypto itself, it doesn't really work that well outside of like the speculation use case when there's like, we do need like the external world to tap into it, right? So like in the past, like a lot of the DeFi activity was maybe around like ETH and leveraging your ETH staking position, which is still a big use case. But now, having these real world assets on chain just opens like much broader set of, applicable use cases as well as just like more capital. And so I think that's why people are interested in it. The yields there are also like obviously more interesting right now since a lot of the crypto yields historically in the rates have come down, obviously based on like kind of the state of the market and all that. So yeah, those are kind of the things that we see pushing the RWA market and why we're interested in it as well.
Super interesting. So I guess yields still tend to be the sort of like the driving factor here, or maybe it's more of like the carrot that everyone can see. Yeah. So interesting times. Tell me more about Symbiotic's new product, the Liquid Lane. Yeah, you guys just did a launch on that, I think a day and a half ago. So tell me, what is it and what is it trying to solve?
Yeah, definitely. So Liquid Lane really tries to solve a very specific problem that we see having analyzed RWA space, which is like, how do you make these real world assets composable on chain? Because, ultimately, if there's just a RWA on the chain and it's just like mirrored, maybe even, or even if it's like natively issued there, if it's not used in DeFi, like there's not really that much additional value gained from sort of being on chain. And all this DeFi composability is really what you are after. Like the other point would just be like access, but okay, so there can be maybe more access on chain if there's like a broader market of participants. Although in the RWA space, there's a lot of compliance gating still. So it's kind of the same set of people that can currently access them. So really you want kind of access to these new financial protocols and the composability that comes with that. And to do that right now, the limitation is that the off-chain sort of structure of these RWAs doesn't really respond well to what we normally need and want in DeFi, which is, highly liquid assets that have a active secondary market with trading, because they have these native redemption windows and some other kind of constraining factors. Specifically, Liquid Lane does address that redemption factor where, depending on the asset, you have at least like a T+1 cycle where you can kind of exit your RWA asset if you go natively to the issuer. So even if it's a treasury, the kind of originator needs to go sell it on the next market day and give you back your USDC, right? In like a private credit fund, sometimes this can be like 90 days or even longer, where they only do it like once a quarter and they sort of see, okay, which people requested to exit, what can we honor in terms of like the liquidity we have available, since some of the duration that they underwrite or the loans have like different lengths. So you kind of need to like balance that and make sure that you have enough liquidity to then enable redemptions. Now, to actually be able to be used in DeFi, so for example, if you want to build a leverage position on an RWA, you need people to be able to liquidate that position, right? So if you're at risk and you've taken on too much leverage, the asset falls in price because of some impairment, then someone needs to be able to take over that position, liquidate it. And for that, you generally need secondary market liquidity. So that's one use case. The other one is just people just wanting to exit more quickly, even if they have to pay a fee for it. And so that's what Liquid Lane enables. We're basically enabling a way, like through an RFQ auction system, to allow people to exit or their positions early by tapping into the vault liquidity that's on some Symbiotic. So vault curators, which are kind of specialized entities such as market makers, can set up these vaults on Symbiotic that can take in stablecoin collateral, and then they can basically allocate their stablecoins towards certain RWAs, and kind of redemptions for these RWAs. So let's say someone comes along, a user of a RWA, a holder of a treasury or whatever, comes and wants to exit it through the issuer. They have maybe like a small button, instant exit for 1% or like for some fee. They press that. The Symbiotic RFQ system registers that, allows these market makers or wall curators to bid at what discount they would acquire it, and then the best price kind of wins. The user gets the option to do it or not, and then they receive the USDC from the vault, and it's all kind of pulled automatically, programmatically on chain, and can also be earning yield while it's not redeeming these assets. So it's kind of like a very specific strategy that we make programmatic and that we allow to be capital efficient by being able to kind of service a lot of different assets from one pool, and by allowing certain whitelisted low risk yield protocols to be as well in the same vault, so you can kind of don't have idle assets sitting and have opportunity cost with it. So we believe this is like a very important product to have, and it kind of it solves some problems that liquidity for RWAs have, and we've managed to convince a bunch of partners also that they see it a similar way, and issuers that want to work with us to solve this. So that's where we are with Liquid Lane, and the issuers that we're currently working with, such as Midas and some of the curators that are coming on board, like including Fasanara, KPK, and some others.
Yeah, I mean, super interesting stuff, right? Because on one hand, you're fixing this like secondary market liquidity problem, and at the same time, you're also incentivizing the people who are helping you with this sort of a model. So and naturally, that this kind of gives that whole extra tooling that the whole industry and the sector would need for it to essentially grow. And I think I was doing a little bit of reading as well in your Twitter post that you believe that or like the Symbiotic's position is that by having a market like this, it does increase the adoption of people in the space in general, right? Having that T+0 settlement just really allows more people to essentially trade the asset. So I do want to ask, right, is the settlement here really the reason that is slowing down adoption, or is it just like a feature that is like more of like a nice to have in this sort of environment?
Yeah, it's an interesting question. I mean, obviously, like, we won't be solving everything with this one feature all on our own, right? It's like the whole system that we're building on chain here on Ethereum mostly is like a decentralized financial system that we're trying to build, right? And it has like a lot of pieces of plumbing that are needed to make it work. Over the last 10 years, we have built a bunch of these core infrastructures, and then now there's like a little bit more optimizations happening and like some new things coming in, and that will certainly remove some bottlenecks, and we'll see how it goes. But I guess there's like a lot of other factors that also factor into this, such as just like interest in these assets in the first place, and interest on getting leverage on them, right? Which is more a market driven factor that we obviously, as a builder of infrastructure, can't control directly. And also don't want to.
Nice.
So
yeah, and I remember you also just mentioned that you were teaming up with Midas as well when you're doing the initial launch about there. So I do want to go back to that a little bit. Like obviously you guys do a little bit of maybe more product testing, or you've had different variations of the product before you launched it into the market. I want to take a look into like an operator's point of view here, right? As the ecosystem guy, when you take this kind of like say this product into a sandbox, what are sort of like the parameters that you like to look at in determining that like placing leverage on this is the way to launch the product forward, as opposed to, let's just say, something like no leverage but like no leverage but like, and no leverage, no same day settlement, but cheaper kind of like premiums for people to withdraw their assets. Like what was like the thinking down here?
Yeah, in terms of how we position it or what we focus on as features.
Yeah.
So I think it's a good question. I do think that we sort of, our core business, I would say, is to like make these collateral use cases bring more of them into existence, and then there is like a sort of secondary order of what exactly the strategies are that are built on top of this, and what the choices are from the curators, and sort of parameters that are more set on the the participant of the Symbiotic protocol level, where we don't want to directly be involved. And I think we sort of saw that for this specific product, we think there's always this issue with the redemption. Like, you can probably take it one step further and say, like, okay, let's make it like one-click leverage, which some teams are building also in this same space, right? And trying to like abstract more from it. But they always will still have the one redemption period to exit the loop. And it's like such a core part of the infrastructure that we were wanted to focus on that part. And then it works also well with sort of our other ideas of exposing the same collateral to like other yield sources and maybe underwriting additional risks on top of it, because it's like quite a narrow focus, I would say. And so we're excited about that as well, to like in terms of like longer term.
Yeah, and that's pretty interesting as well, because by doing that, like, now the product, like, at the face value, it looks like it's liquidity infrastructure, but at the same time, you're actually building a market for collateral itself, right? It's like, like, how could your LPs, generate some sort of upside as well as they work along with you in the product. And I think that kind of creates like a win-win, right, for the partners here. And I think that's like a really interesting take on that too. So yeah, so I'm just trying to like to figure out like whose idea was that? Was that yours? Was that a collective of the team?
Yeah, I think I mean, I shout out to Enrique here, who's been leading this product in my team, that definitely has been pushing this a lot with the different parties. I think it's been a problem statement that came up a lot in our conversations with the with just people in the space as we work through it. And so we sort of figured that we can play a role here. I think, obviously there's like many other approaches to this as well, including, we looked at a lot of the assets, what they are currently doing and how they built like liquidity buffers into the asset, just by kind of keeping a portion idle. I think we are also seeing that with Athena, right? Or like Henri and all these products, like a lot of them are actually now sort of just this tokenized allocation system that actually has like some sort of different liquidity exposure and different like duration exposure within their asset anyway. But we thought, hey, why, like, we could build something that makes use of the composability of DeFi as well, and the shared liquidity layer, right? Where this is something that we've already been working on forever, right? Like sort of this idea that, which I think also what crypto is especially good at, right? Like making something available across the market and composable with other things, where instead of like fragmenting it more. And so that's where this comes in. And I think you always want to kind of balance also the ability for people to have like custom like exposure. So like maybe some vaults or some curators might not want to have exposure to a certain asset, even if it's just for the short duration. They might not trust a certain RWA, while others will. So we're trying to build a system in a way that we can kind of capture all these different opinions and have a market where, in the end result is kind of the best price for the people that want to redeem these RWAs or that have to liquidate it. So
yeah,
that's where we're going. And we do have like a bunch of research also into how this is more efficient specifically for these kind of assets versus like some of the other existing solutions. So yeah, happy to dive into that as well. And I think,
yeah,
we're posting some research about that as well.
If let's say like we do, efficiency aside, right, and we just like focus on like keeping capital within the system, what kind of incentives like do you guys put in place to essentially keep capital in the system during, let's say, periods of stress, right? Does the model here become more attractive or less attractive like during like a crisis, for example?
Yeah, I think it's at least like another option that maybe is also way more transparent than if it were just like some market maker deal off chain that says it buys the asset, because you can see like the vault liquidity that's there on chain. You sort of have it more transparent. But I do think there's still like ways like curators decide what they bid on and which assets in that moment. So if there's like a big stress event and someone thinks it's like only the market is wrong, they can bid and buy this distressed asset. So we actually have like a bunch of curators that are quite interested in that and would double down in such situations, right? And then it's just an efficient market, right? In other situations, it might be like, asset is that, then probably no one will bid, right? It'll like figure it out. I think what is happening is essentially we can really isolate it to this specific risk that you're getting exposed to, and then pricing that correctly through like these entities that have an interest in doing that and have the expertise to do it as well.
Yeah. And I think it's super interesting as well because it really brings that question, like what really is like the fair market price of immediacy, right? When it comes down to like a stress event, like what are you willing to essentially like take a haircut on for that? So it kind of reminds me of that movie Margin Call. There was it was like the opening 24 hours of the 2008 crisis, and they were like just trying to offload everything. So I would like to ask, like based on your testing and just like taking a look at what's out there for the market makers, like do you guys never notice that a similar pattern when it comes down to pricing immediacy?
Yeah, I mean, so far, like a lot of these assets they are pretty well traded in the traditional world, and you sort of have the volatility numbers of them, and the drawdowns are not as extreme as probably some things we've seen in crypto already and what we're very used to. So I do think these are like much safer, but we'll see. Of course, there probably will be some situations where some of these assets might be like significantly impaired. Depending on that, we will also on the platform, there is like due diligence that we do and help do the curators about like assets and which assets we list and so on. So there's a certain amount of guardrails there, but ultimately that's certainly a likelihood. But in the end, we're building like this marketplace and this platform that should figure it out and give you the option to do either buy or sell it or not participate or participate, right? And I think that's
let
like
the market
crypto
decide.
just generally happen. Yeah, I think you
Yeah.
don't want to like intervene too much in a way, like, right? It's also like problematic if you're as the platform do that. So I guess that's like a core thing in crypto. If it's like a pooled model like Aave, right? You have the risk curator, basically the Aave DAO being like sort of making these calls. We're following the curator model in the sense of these vaults can set it up for themselves and they will have like certain constraints. We don't want them to. We're actually we have quite extensive like sort of system of they can only do this with the asset, right? They can just withdraw the RWA and run away. It's basically in the smart contract custody that only allows the redemption with the issuer or participating in this RFQ. So there are like certain guardrails and constraints in terms of like protecting the vault LPs that are like quite sophisticated. And I think that's sort of the system we're trying to build here and extend to different use cases as well.
Yeah. Interesting. Like so we've if let's say like we were to make a comparison between like what's available in traditional markets and we work towards what's new in crypto, right? I guess the question would be, why, if let's say an institution that's participating in both markets, why would they choose a market-based liquidity network instead of, just simply waiting for redemption, like what they would get from outside, like from outside of crypto, because that's something a little bit more familiar. That's something that, that's more guaranteed. That's regulated. How do you guys separate yourself from that part of like the industry, in being competitive and drawing outside capital into crypto? What do you guys have in place there?
Yeah, I think I guess to the original first question, I think generally it's shown that markets generally exist because people want to take certain positions or want to like maybe exit the position instantly, right? That's like a demand that's definitely there from people, and they will have a willingness to pay some amount for it. Essentially, what we're building here is just the most efficient mechanism to reveal that while sort of isolating that while you kind of also are capital efficient in the sense of you're not missing out on opportunity cost of having this capital just lay around from the other side or things like that. So
which I think is one of the coolest things, by the way.
Yeah, definitely.
About
I
the
think
product.
that's kind of the unique value proposition. I think you can just have a liquidity buffer. You can ask your market maker to redeem it for you, right? And that might work. That might also be expensive depending on like how you structure this agreement. I think our idea is then it's a competitive marketplace and you can do like all these things in parallel that should lower the cost of capital, and that should result in the best outcome for the individual user. And that's the thesis.
Nice. Well, I'm super excited to see what's going to happen with this chapter for RWA. I think like you're right, like so many different type of products have come up trying to solve this question, from one click leverage to a marketplace to same day settlements, like what you guys are doing. So I don't know, it's a really exciting space to be in. I wanna talk about Symbiotic now, because you guys have been pretty flexible with what if you guys been kind of like building, right? First, you've been doing like financial underwriting, then you've been doing staking infra with Cap, and now you got Liquid Lane. What's next for Symbiotic? Like, what is the thing that you see, where Symbiotic can apply themselves to really like make a statement in the market?
Yeah, I think we followed this approach from the start, like to be this collateral market, and it's like a quite long-term infrastructure thing. So obviously it means it takes time to build it, and it takes time for people to understand how to use these primitives and how to like put them into products. And I think, with Cap being like one of the first that managed to build a functioning system around it that has some traction, that can generate fees, the first one that generates real yield. So shout out to them for actually understanding better. We were kind of initially basically the infrastructure builders that built the tooling, sometimes with a broad idea what can be done, but not like with a very specific one. And then sort of these emerge over time, right? I think even like Ethereum, right? If only Vitalik built it, he didn't think of all these things that came out, and maybe thought of some things that actually didn't happen. Obviously, right? If you read the Ethereum white paper, there are things that actually now, after a longer time, became viable, but they're also not built by Vitalik himself. So yeah, it's a kind of a similar approach where we knew like, okay, this infrastructure will be useful for this. Let's get people building on it. Let's make it as developer friendly as possible. And now it's also like, okay, we've seen what exactly will be useful, and let's build like even better tooling for like more niche or more specific use cases that we've identified, which are these financial underwriting or now RWA liquidity use cases that are just really what crypto as a overall technology is most suited for, and where we believe we can provide like unique value through like sort of this shared collateral layer and marketplace. Yeah.
Nice. And I think like that's kind of like well, when if you think about like crypto, you always think about like modularity, and you're building out this like collateral marketplace, right? Do you think that there could be an inevitable future where we just start tokenizing like everything in this like collateral market, from like the vaults to the LPs to like the time, like the immediacy? Like that's kind of like what you guys are already working on, right? So what do you think that it's just like the way that it's designed to be modular that makes it really competitive, and also what the industry is going to direct itself towards with different ways to nickel and dime your way across the whole value chain, right? Do you think that's like something that will happen, or like or something happens in regulation, and then everything that and like someone comes over and like sets like the rules, and like what you can only do it like this way?
Yeah, right. I mean, I guess I can't really comment on that what exactly I think will happen there, or even I do think that's obviously another interesting discussion as well. What should be happening, or how should states approach this? I think from our perspective, or from my perspective, surely if a lot of things will be tokenized in a lot of different ways. I think, there was also like some great reports recently, like the different forms of tokenization, right? It's like some people will just like claim it's tokenized, but actually it's just kind of like mirrored, and actually everything still happens off chain, but you just see something on chain, right? And then you sort of have these more crypto native, or like things that are from first principles built on the crypto rails. Some of them even like come directly out of the system itself, like ETH as an asset, right? Like obviously they are kind of the native crypto monies, but then also like this interaction with the real world, the Oracle problem overall. I think we're still like kind of solving that, and there's like different approaches to it, and I think we will have, and hopefully we are building like one part of that enables it, like things that are in the real world to be more on chain and tap into this composable infrastructure. I do think that we're yet to see like more experimentation of what it can mean to build a RWA like kind of natively on chain, and like teams that have maybe that don't just, not maybe institutions that already have their asset off chain and have these structures there and just put it on chain, but maybe like something that from first principles is built on chain, like even like deepen networks. I think was like interesting, something that kind of touches the real world but was like built on chain from the first principles. I think we'll have like more experimentation there, and that should hopefully make crypto grow and be like the bring adoption.
To more experimentation. Yeah. All right, so we are at the final minutes of the show. I would like to close, like with this question here, like what is the best way that people can find you and get involved with Symbiotic? How do they participate in Liquid Lane and what's going on right now in the RWA space? What's like the best thing that they can do right after this video?
Yeah, thanks for giving me the opportunity to share on that. I mean, you can follow us on Twitter, Symbiotic or me, Felix LTS, tweeting about these topics every now and then. I'm probably not as active as I should be, but bear with me. It's worth it still, not crowding your feed as well. And then also you can just go on our website, Symbiotic.fi. There's like currently a banner and like a menu item to go to Liquid Lane. We have a wait list open, so you can sign up for that. We're currently working on releasing the system with these issuers, right? If you're an asset issuer, you can get in touch with us if you want to have this system, liquidity system, as part of your liquidity sleeve. If you're a curator that wants to like participate in the system and quote, yeah, get in touch as well. And even if you're like a passive LP that wants to like earn yield from this, those will be the places there to look into. And yeah, I think that's pretty much it. Thank you, Neil, for having me.
And it was a super, super nice and interesting conversation to have you on board as well, Felix. Thank you for coming on. Thank you, everybody, for tuning in to this episode of the AthenaX. I will see you at the next one. Bye-bye.